Hello from a rather grey, wet and miserable Monday the 19th. I'm FxPlew and this is the market brief. The Bank of England raised interest rates last week for the 9th meeting in a row now. That moved the base rate to 3.5%, but it won't be the last interest rate hike we see. Estimates suggest we may be around the neutral rate now, but only time will tell if rates are restrictive enough to dampen demand and to see inflation fall. Many analysts still feel the MPC should have acted more aggressively earlier in the cycle because the UK has been left with one of the weaker outlooks of the G7 and stagflation is looming large over the economy. Hindsight is a wonderful thing though, of course. Nevertheless, sterling rallied in the market. We saw the highest level since June as the market reacted to the rate hikes. We topped out around 124.45 against the dollar last week, but we start the new week a little lower. We're about 121.75 against the dollar, about 114.55 against the euro, and euro dollar starts around 106.30 this morning. US activity is expected to slow this week as the market gears up for holiday season. We've got Q3 GDP due out on Thursday. That's expected to be around 2.9%, a bit blowy. And weekly jobless claims are expected around the 200,000 new claims mark. Focus is, of course, on the employment data, as many analysts are still forecasting a negative headline number for non-farm payrolls by the end of Q1. Right now that looks rather pessimistic excuse me, given the recent strength of the payrolls data though, so that's one to keep an eye on in the new year. The dollar index is still driven by the outlook for monetary policy. That dropped to about 103.45 last week, but it recovered to close the week out around I think it was 104.75 on the close on Friday. Right, that's it from me today. Join me again tomorrow.
If you do not have a clue, then just tweet through and ask FxPlew.